Today, we're starting the accounting cycle. But before journal entries or financial statements, there's one thing everything depends on. Most beginners think accounting records everything a business does. But that's not true. Accounting only records specific events called business transactions. But what exactly is a business transaction? A business transaction is any event that affects the business financially. This is the core rule of accounting. If an event changes the financial position of a business, it is considered a transaction. If it does not affect the business financially, it is not recorded. So accounting is only focused on financial impact, not general activity. Now let's look at the common types of business transactions. Business transactions come in different forms, and you can see some examples on the screen, but this is not an exhaustive list. However, all of them follow the same rule. They must affect the business financially. Each type represents a different kind of financial change. Even though they look different, they all impact the accounting system in some way. So what is not a business transaction? Accounting is very specific about what it records. It only records events that affect the financial position of the business. So anything that does not create a financial impact is ignored in accounting. For example, non-financial activities are actions that do not change money, assets, liabilities, or equity. So these are not counted as a business transaction. Future intentions are things that are planned but have not yet happened. So there is no financial effect to record. Another example would be internal thoughts or plans. These are decisions or ideas inside the business that have not resulted in an actual financial event. The key idea is simple. If there's no measurable financial impact, it is not recorded in accounting. There's a simple method to identify transactions. Just ask these 3 questions. Did an event occur? Does it affect what the business owns or owes? Can it be measured in money? If all 3 conditions are met, it is recorded as a business transaction. Now let's understand how this moves through accounting. Once a business transaction is identified, it does not stay isolated. It enters the accounting system and follows a clear process. First, it is recorded. Then it is organized and processed. Then it will become a part of financial reporting. This is how financial activity becomes structured accounting information. This is also why identifying transactions correctly is so important. Without transactions, there are no accounting records. Without accounting records, there are no financial statements. This shows that everything in accounting starts from this very first step. Now let's do a quick check to test understanding. For each statement that I'll show, decide whether it is a business transaction or not. A business decides to expand next year. This is not a business transaction because nothing has actually happened yet, and there is no financial impact at this stage. It is only a future intention. A business pays rent for this month. This is a business transaction because money is going out, and it directly affects what the business owns. It changes the financial position immediately. A manager has an idea for new pricing. This is not a business transaction because it is only an internal thought or idea, and it does not affect the financial position of the business. Now, let's quickly wrap everything up. Accounting only records events that affect the financial position of a business. These events are called business transactions. They form the foundation of the entire accounting system. Everything in accounting starts from identifying them correctly. So that's the full explanation of business transactions. This is the very first step in the accounting cycle, and everything in accounting starts from identifying this correctly. If this concept is clear, the rest of accounting will become much easier to understand. Next, we'll learn about the chart of accounts and see how accountants organize transactions into different accounts before recording them.